This segment sponsored by Foster Financial. Welcome to Wealth Wednesday, where each week we give you financial advice, joined by our financial expert, Caleb Doan with Foster Financial. Hi, Caleb.
Hi.
Welcome back.
Thank you.
Yes, a new day and a new topic. So today we're going to talk all about timing the market just right for investments. And this is something that's quite mysterious because it's like, can you time it or not? But you're going to break it down for us today?
Yeah, that's exactly right. So I think this is something that typically comes up whenever we see the market drop like it did in 2022. And it's kind of the phenomenon where people will see, their 401k or whatever it might be drop by 10 or 15%. Then a lot of times they say to themselves, I want to avoid another drop. If the stock market drops 10%, I don't want my funds to go down another 10%. And so what people will say is, okay, I'm going to sell all my investments to cash, wait for the stock market to go down, and then try to time it just right when it's at the trough, buy back in, and then take advantage if there's a market recovery. And of course, the potential pitfall there is nobody truly knows when the market is at its trough to be able to buy back in. And so there can be some drawbacks to trying to use that strategy.
Yes, and that seems to be really the main concept of stocks, right? I mean, having something that's a little more risky, as we talked about before, something that's conservative or something that you can kind of play with a bit. But what do you think when it comes to people actually making that attempt themselves to actually predict what the market's going to do? Yeah,
I think most of the time we see it probably causes more issues because if you dig a little deeper, the perspective behind that is thinking about stocks in a more shorter term environment. They're saying, I think that the stock market's going to go down maybe in the next 6 months or the next year. And what we encourage people to do is not necessarily think about the next 12 months or 24 months when your money's in the stock market, but know that you're invested for the long term. And so we want to establish these goals 3 or 5 years out. And typically, when we look at 3 or 5 years out, we're a little bit more optimistic when it comes to the stock market.
Right.
And so I think there's a study that was done too that said, if you invested $10,000 in the S&P 500 in 1993, so 30 years ago, by 2022, your $10,000 would have grown to over $150,000.
Oh, wow.
So, amazing returns over that time period. Of course, doesn't guarantee the stock market's going to continue to do that, but still, if you would have missed just the top 10 trading days within those 30 years, your returns would have been cut by over half.
Oh, wow.
And so that can tell you, if you're attempting to time the market and you miss some of those good up days, it can really have a drastic impact on your returns. And so that's just missing 10 days. If you missed 30, your returns drop by over 80%.
Wow. And that, of course, is with a more tangible currency. But this happens with Bitcoin and with cryptocurrency, right? And all the NFTs and the craziness that it's like, how do you keep up, trying to predict it? So what do you think is the biggest danger, someone trying to do this prediction themselves?
Yeah, that's a good question. I think that the danger is really missing some of those potential upswings, especially when you're in a down market. The thing that everyone's looking for is the potential recovery that could happen over the next 3 to 5 years, even though the market is still down from its all-time highs. And so historically, we've seen some of the biggest market upswings have happened after the market has dropped, of course. And so then eventually, you look for that recovery. And so when the market's down, that's when a lot of people get this idea that, hey, I don't want any more losses, but if you sell to cash, then you could miss that potential recovery.
Yes, absolutely. And I think we kind of saw a little bit of that this year, with things that have just been happening in the market with inflation and all of that. So do you feel that 2023 is a really great example of the pitfall of it all?
Yeah, it certainly is. Because, in 2022, of course, the stock market went down. And then even through the beginning of 2023, we've still had high inflation. Interest rates have still continued to rise. We had banking issues. And, now there's some of the talks of the debt ceiling.
Right.
But still, in Q1 of 2023, the stock market went up pretty significantly. And so if you were somebody at the beginning of the year that was thinking, oh, I want to try to time the market, then you would have missed that recovery in quarter one of this year. And so that's why we like to encourage people to stay invested for the long term, have that long-term perspective on your investments, and then hopefully realize that recovery if and when it happens.
Yeah, that's great. And these are things that you discuss with your clients, right? So they can kind of get a better understanding and gain sound advice when they come in to see you.
Yeah, that's exactly right.
Yeah, awesome. Well, thank you so much, Caleb, for sharing with us about our risks today. And I'm excited to talk to you about Women's Wealth Wednesday next week.
Yes.
Thank you. If you would like more information about Foster Financial, give them a call. We'll have their phone number listed below, and we'll be right back. This segment sponsored by Foster Financial.